All right, I think we'll go ahead and get started. So this evening we're presenting our webinar, The Veterinary Market in Flux. It's our review of kind of how the first quarter went for the practice sales market. Richard, we go ahead and move to the slide. We'll get to some housekeeping and other good items. A couple of quick little Zoom reminders, if you will. One, we will absolutely answer questions. There are a couple of different ways that you can ask questions in the Zoom portal. One would be there's the Q&A box. You can also go ahead and throw something in the chat that we will see. So don't be shy, absolutely ask questions. We'll try to address as many of those as we possibly can. We'll also go ahead and send in the chat function a link to Rich's Calendly calendar. And if you have any kind of very specific questions to your practice, again, don't be shy. Go ahead and book some time with him. He'd be delighted to talk about things and answer as many of your specific questions as he possibly can. Who is Ackerman Group? Why are we here tonight? Why are we talking about these things? So Ackerman Group is the largest broker of veterinary practices to corporate buyers in the profession. We've worked in 49 out of the 50 states, not Alaska yet. And we've worked with practices of all shapes and sizes, general practices, specialty, ER, hybrid, equines, all sorts of things. We've done over $2 billion in transaction value since 2017, worked with a lot of practices, a lot of buyers. We're averaging about a transaction a week. And I think that the interesting call out from that is that that is something that indicates that we have some of the best real-time knowledge of what's happening in the market relative to just about any other advisor that's out there, whether buyer side or sell side. And we try to share a lot of that information that we garner through all of that work with all of you during these webinars. Tonight's session is entirely about kind of thought leadership, what we see in the market, what our opinions are on how the market may or may not trend going forward. And as that's a good example of how we kind of think about expertise across our entire team. We have a very deep bench of folks that work with our clients on their practice sales. All of them are kind of functional experts. And tonight you have one of those functional experts, Rich Lester, who I'll introduce in just a second. So who is Rich? Rich is the CEO of Ackerman Group. He has spent a number of years in the veterinary profession, was actually a founder of one of the buyers that's out there. And so has perhaps one of the deepest knowledge sets of anybody in the profession around how transactions benefit sellers, how they benefit buyers, what we see in the market, and how that trickles down to all of you. So you're certainly in for a treat tonight. Rich, you want to go ahead and get started?
Yep. Thanks, Wynn. I appreciate the kind words and the introduction, and I appreciate all of you listening in tonight. Hopefully what I have to tell you will be informative and helpful as you think about your practices and your businesses. Tonight, as typical in these sort of quarterly updates, I'm going to start with what's going on macro in the US and world economy. And over the last 3 months with tariffs, inflation, the economy has gotten a lot of things going on. We'll talk about the veterinary services market, and this will be probably the third webinar where I'm talking about whether it's at an inflection point or not. I think by next webinar, I'll have to use another term because either it will be inflecting or not. And then finally, we'll talk about deal structures and some trends in the industry. So let's start with tariffs, inflation, and the economy. And I think the highest level comment is, as of right now, I've been in my 30 plus years of adult lifetime, I don't know that I've ever seen the economy with more uncertainty and flux. And so as President Trump has implemented new policies at a dizzying pace, the lack of certainty of what's going to happen next is really impacting how businesses are making decisions. And so let's start with tariffs. And as many of you saw, President Trump a couple of weeks ago announced a whole array of tariffs, which would increase prices to consumers dramatically. After a couple of days of stock market sell-off, he delayed the tariffs for 90 days and the stock market rebounded some. However, he did keep the tariffs on China in place, and those tariffs are at basically 145%. So if something costs $5 to make in China or is being imported at a $5 cost, you will then pay about $7 in tariffs. So the cost will now be $12.50. And so the cost of buying items from China have just gone through the roof. And whether this is a good policy or not, there's lots of debates. I mean, there's lots of reasons to think that China is doing a lot of nefarious things and that we should be putting a lot of restrictions around China. The question and the challenge for most businesses is there hasn't been a lot of warning and there hasn't been a lot of certainty around the tariffs. So it's making business owners and small business owners and large business owners quite hesitant about what they're doing. I've got a link here to a New York Times op-ed piece that was one of the most thoughtful pieces that I've read about tariffs. And I think we're going to put the link to it in the chat so you can look at it. But it's basically talking about it's written by an entrepreneur who imports a product from China at $5, and he pays $5 for the manufacturing of his kitchen product. And then he sells that product for $50. And he walks through all the pieces of the US economy that he supports by bringing this product over for $5. He sells the product through Amazon, and Amazon takes fees, and those Amazon fees pay for workers at warehouses, and it pays for workers who deliver the product. He pays PR people. He buys QuickBooks software to run his business. He buys, a CRM software. And so his point is that he's generating a lot of economic opportunity in the US through his importing of this product for a small amount of money from China. And his argument is, do we want to bring this manufacturing to the US, or do we want to make sure that all the other higher value services that he's buying in the US keep happening? And so there's lots of arguments around the pros and cons of tariffs. The bottom line is, for us as an industry, it doesn't do a lot because we're local service businesses. But for a lot of our customers at veterinary clinics who are in businesses that are international or importing products, it's just creating a lot of economic uncertainty. And I think that economic uncertainty will start being felt as data comes out over the next couple of weeks. So I'm going to talk a little bit now. I've put this slide up for many webinars, and it's what's happening with inflation and monetary policy, or inflation and interest rates. So the blue line are interest rates. And when inflation spiked during COVID, interest rates eventually were raised from 0 to over 5%. That brought inflation down. And then inflation's been muddling around the 2.5% to 3% range. And in March, it's actually was as low as it's been in a while at 2.4%. But the China tariffs went into place in early April. So there's an expectation that April and May, that inflation will start ticking back up. And because there's fear that inflation is going to start ticking back up, the Federal Reserve is not about to start lowering interest rates because they're concerned that inflation's coming back, and you kind of got to leave rates high if inflation is high. The labor market is also clearly softening. And I'd say that most economists think that a recession is around the corner, and that this idea of a soft landing, which seemed to be likely, is less and less likely today. what defines a recession? A recession is 2 straight quarters of negative growth in the economy, and GDP is the measure of growth. And to be honest, GDP has been pretty strong through the end of last year, through the end of Q4. Tomorrow, I believe, or tomorrow's the 30th of April. The Labor Department is supposed to release its GDP estimates, its GDP numbers for Q1 of 2025. Economists expect it to be negative 2.2%. That would not be a recession by the technical definition, because it'll only be 1 quarter of negative GDP growth. But the expectation is that negative growth continues for a bit as we have all this economic uncertainty. What I like to say about President Trump is that he's doing to the economy and to the federal government exactly what he had promised during his campaign. And he talked about hitting the ground running to make changes to the government. And through DOGE, he's doing that. And there's some benefits to all these changes. One is by eliminating a lot of the federal bureaucracy, he's effectively deregulating the economy. And our economy, many people would argue, has too much regulation. And so instead of trying to eliminate regulations one by one, he sort of has eliminated a lot of the bureaucrats and people in Washington who enforce the regulations. And so it's going to be interesting to see over time the impact on that, on product safety, on the environment, and all the different departments of the government that do enforce regulations that are now going to be materially understaffed or have a lot less staff. He's also put in place his America First policy, which is including putting the tariffs in place. He's putting a lot of pressure on our allies to increase their military spending, so that burden comes off of us. Again, there's benefits to a lot of these policies. The execution, I would say, is abrupt, but a lot of things that are happening, and it's impacting what I would say is certainty and consistency in the economy. The amount of activity that the administration has put in place in the first 90 days is unprecedented, with moves on immigration, tariff, DOGE, his changes in foreign policy in Russia and Ukraine, et cetera. And Congress and the judiciary are basically doing nothing to block anything. So the executive branch is just making stuff happen. My underlying view is that there's a lot of change that's going on, but the long-term strategy is going to be to focus on China and battling China both economically and for influence throughout the world. And that's why he's left the tariffs in place on China and nowhere else. The question will be will he build alliances with other countries to help with that economic battle with China? Time will tell. Anyway, the question then becomes, how does all this stuff impact each of you who are running veterinary clinics? And I would bet that those of you who are in the greater DC area, in Northern Virginia and Maryland and Washington, DC, my guess is that you have clients who've been impacted by layoffs of the federal government, and that may impact their spending. If the economy does go into a recession, it will impact spending at veterinary clinics. So we as an industry are not immune to the macroeconomic picture, which is why I spend time talking about it during these webinars. The problem is the economy actually in 2023 and 24 was actually growing nicely and doing well, but our industry has been having lingering problems post-COVID. So a couple of things to set the stage on this industry growth slide. Before COVID, which is sort of the left half of this graph, our industry was one of the more predictable and consistent industries out there. Throughout the 2010s, revenues grew 4 to 6% annually, and visits grew about 1%. And so during the 2010s, the economy grew about 2.5%, and our industry was growing revenue 5%. So we were growing at double the rate of the economy as an industry. And it included visit growth. So the industry was expanding. That led to a tremendous amount of capital coming into the business, into the industry, because we were growing at such a steady and healthy rate. Then came COVID and growth skyrocketed. And we had unbelievable years in 2021. And that led to a lot of stress. It led to a lot of price increases. It led to people leaving jobs, a lot of turnover. And when you have such steady and such strong growth, there's usually an aftershock where things slow down. And the problem for the industry has been for 12 straight quarters, and IDEX will announce their earnings in the next couple of days, and it'll likely show that there'll be a 13th straight quarter where the industry has had invoice growth of negative approximately 2%. And so for a couple of years after this heady growth in 21, you can say, hey, it's a little bit of a hangover from that heady growth. We're now slowing down and we're going to revert back to the mean. And the reverting back to the mean was what happened pre-COVID. The problem is we're now 13 quarters into this post-COVID slump, and there's no real end in sight. If the economy, especially this year, slows down, the likelihood that we have invoice growth is going to, in my mind, is pretty low. But what's remarkable about our industry is despite the lack of growth, valuations for individual veterinary practices have gone up. And if you look at this graph, starting in 24, we saw valuations climb, and they've sort of held steady in 25. So what is happening? So first on this graph, the details, the weighted average general practice multiple, which is this lighter green line, is continuing to go up slightly into 2025. And that's telling us that the larger deals are still at a premium and getting really strong valuations. At the high end, we're seeing 13, 14, 15 times EBITDA for the best practices. The simple average was down, which is the light blue line that's going down a little bit here. I'm sorry, which is the darker blue line, which is going down a little bit. And that's due to the fact that we sold a lot and had a high transaction volume so far in the first half of 25. And a simple average is the simple average of all the deals. And we did a fair number of smaller deals, and that's bringing the overall simple average down. But the weighted average is up. That's telling us that the higher value practices are continuing to be strong. And then this light blue line includes ERs and specialty, and we are seeing those sell at a slight discount to the better GP practices. So at the end of the day, the market's getting it's a little more complicated. It's not just a straight line up, but we are seeing still strong multiples well above pre-COVID levels and well above sort of 2023 levels. We're not back to 21, 22 levels, but pricing is still strong. And so why is pricing still strong? So I would argue it's not because industry fundamentals are good, because obviously invoices are down. It's that there's a supply and demand imbalance. And the number of hospitals sold hit a trough in 2024. So these blue bars are how many hospitals were sold. And in 21, it was over 1,000. But in 24, it was about 360 hospitals. And so the number of hospitals being sold goes down. And the demand is still strong. That leads to a supply and demand imbalance. And many groups are still looking to expand despite the economic times, and they want to show growth. So they're looking for assets or hospitals to buy. And there just wasn't a lot of assets out there in 2024. we are seeing volume picking up in 2025. Did I stop sharing? I'm sorry. Hold on. Whoop. And hopefully everyone can see my screen still. So we thought 2024 is probably a trough in the volume. And we are expecting, based on what we saw in the first 4 months of the year, that volume is going back up this year. Unclear if it'll stay strong the rest of the year, but we just signed a couple of letters of intent in the last 2 weeks, and pricing hasn't changed in our view for the things that we have actively in market. And as Wynn said at the beginning of the webinar, at Ackerman Group, we're selling the largest number of hospitals in the industry, so we have the most real-time data on what's going on. And it's been a great first 4 months of the year so far. What else is going on in the market? So there was a shortage, or there was a lack of supply in 24 that helped took valuations up. We also saw the first large recapitalization or sale of a large consolidator to a new investor happen in December of 24. SVP and MVP merged. They took a new investment from Silver Lake Partners. The valuation was pretty good. It wasn't great. It was 17 to 18 times EBITDA for those two businesses. It's below the peak from 21, 22, which was over 20 times EBITDA. And it's, they're relatively well-run businesses, so it's established sort of a new reality for what valuation looks like for these larger consolidators. And it was the first major recap in 2.5 years. The thing that's happening right now is there's probably 10 other companies that wanted to sell themselves or do a recapitalization, but with all the economic uncertainty and potential recession, everyone seems to be putting their brakes on things and slowing down. And so will those recaps happen in 25? Unclear. There's been talk since 21, 22 that there'll be IPOs. We don't see that happening till at least 2026 or 27. So there's a lot of uncertainty on the recap side because of the economic uncertainty that's out there. We hope that the hope of the recaps and the supply-demand imbalance will keep veterinary practices at reasonable valuations. Why do I say the market's at an inflection point? I say that because we've had this period of invoice decline. The industry isn't a guarantee of growth that it was before COVID. We've had 3+ years of this invoice decline. We think a lot of that is due to aggressive price increases that were taken during COVID because everyone was so busy. But from an investor standpoint, will investors start viewing this as a fundamental change in the industry? And if they do, that will take valuations down. As long as they still believe it's just, hey, there's a cycle. We had tremendous growth during COVID. Now there's a cyclical downturn, and we'll see the growth again in the future. If that's the attitude, valuations will stay strong. I don't know if it's 4 years of decline. At some point, investors will say there's been decline for so many straight years. Maybe there really is a fundamental change. Hopefully that doesn't happen, but that's the risk. And it's why we've been saying to sellers that if you're thinking of selling in the next 2 years, you should do it now before a potential market downturn. If you're going to hold for at least 2 years or 3 years, that's fine. You can hopefully hold through the cycles, and the world moves in cycles. And if there's another cycle, you'll be fine. If you're going to hold for a while, we've got multiples in the 8 to 14 range. The higher end stuff is really in demand. There's lots of interested buyers. So it is a good time to sell, assuming the economy holds on for at least a couple of more months. And for everyone that all of our existing clients that are in the process of sale, we are pushing to move those processes fast because we don't want the economy to turn on them. So that's the market. Let me now talk a little bit about what we're seeing with how deals are specifically being structured and trends in those structures. So the market started to adjust to declining interest rates occurred in sort of 24, and that led in 24 for us to see an increase from 22 and 23. We saw more cash up front in 24 and 5 as interest rates went from 5.25 to sort of 4.25. So lower interest rates means people can put more cash in. But every buyer at these prices is still looking to de-risk deals. And so there is structure in every deal. And structure is just a fancy word for we're not paying all cash. And the deal structures include some top co-equity, some joint venture, some do joint ventures, and some do contingent notes and earnouts. And so there is more structure in deals. We're seeing for the last 3 years how important doctor recruitment is. And a few things to know about this is, one, if you're producing a lot of revenue or a high percentage of revenue at your practice, a buyer is going to typically ask you to stay 3 years. And if you're in a hard to recruit geography, that could be 4 or 5 years. Retention incentives are now the norm for doctors, for associate doctors. You've got to pay them some to stay. I've said already that the strongest demand is for the best practices. We define that as 4 or more doctors and over $500,000 of EBITDA. And the market remains robust, but it's changing. There's lots of different buyers out there. So let me go to some specific data on deal structures. Cash became king in 2024. And what this chart shows is 4 different years of data. How many deals had less than 60% cash? How many had 60 to 70% cash? And how many had over 70% cash? So you can see in 2022 and 23, and this is 70% or more. We can see in 22 and 23, there was not a lot of deals that were offering at least 70% cash. Last year, that went up to 81% of the deals were at least 70% cash. This year, it slid back a little bit, but it's still a 65%, basically 65% of our deals are seeing 70% or more cash up front. And for those of you who are selling, cash is certain. You close a deal, cash goes into your pocket. The other payments, there's always some risk to it. So a lot of our sellers who are thinking about retirement want more cash up front. So it's a good trend to see the cash there. And then this is a really important slide, and it also speaks to why having a good broker is important if you're selling your practice. The dark blue represents the number of new buyers that we are working with each year. And the light blue represents the number of existing buyers who've worked with us before that we sold to this in a given year. And so already in the first 4 months of 25, we've sold to 3 new buyers who had never bought from us before. And in 24, we also sold to 3 new buyers. And we've been in business a long time. We work with a lot of different groups. And so we track this to show the community and the industry that new formation of buyers is happening all the time. There's really low barriers to entry in our industry, and there are new market entrants. And so if you're looking to sell, the names that bought your friend's practice in 2021 may not be buying today. There may be 5 new companies that are buying now. And so understanding the market, really, really important. All right, that's a lot of info. So let me summarize a few things. And this is sort of a little bit of a Ackerman Group sales pitch. Like, if you're looking to sell your practice, the buyers have an enormous amount of expertise. They've got business development executives who you're going to always like because they're salespeople. But supporting them, they've got financial analysts, experienced legal counsel. They've got a senior management team that usually has decades of transaction experience. And you've got private equity firms that are backing them that they do this stuff for a living. And you, as an individual seller, you haven't really sold many businesses typically, and you've got maybe a lawyer helping you figure this out. Our advice is, if you're going to sell, get a broker, help rebalance the scale so that you have someone who's really experienced at working on these transactions and understands all the nuances and details, because purchase price is one of 30 important deal terms, and making sure that they're all understood and figured out critical. So, summary, the economy, as I've said over and over, is in a state of flux. Interest rates have stabilized. The Fed is reluctant to lower them right now due to the uncertainty. Recession seems a likely scenario as economic growth is slowing, and consumer confidence is down because of the uncertainty. In our industry, we're trying to figure out if invoices will revert back to pre-COVID norms or not. Despite all this, valuations are still really good. Buyers are being a little bit more conservative with their cash in 2025 than 24, but they're spending way more cash than 22 and 23. And so before I go to questions, I'll also make two quick pitches. One, at Ackerman Group, we run a conference for practice owners only. It's called Insightful.vet. It is the only practice owner exclusive conference. There's still an early bird registration for the conference that's in November at the Ritz-Carlton in Las Colinas, which is outside of DFW. It is content that is about 2/3 geared towards how to run your practice better. It is not about selling your practice. The majority of the conference is about how to run the practice better. And about 1/3 of the content is about the economy and deal structures and your real estate and stuff like that. These are some pictures. I'm not going to linger on the QR code, so I'll make one more plug. My partner who did the introduction, Win Lippincott, is going to do a webinar in 2 days, 2 days from now. Anyone who's on this webinar who wants to get a deeper dive into all the things that I've talked about, he's going to take pieces of it and go much deeper on Thursday. If you've got the energy to do that, feel free to join that webinar. You will all be emailed a link to register for that, and it's also in the chat. So now I'm going to open it up to questions, some of which I don't know if any of it's in the chat, but the best way to ask questions is to put them into the Q&A. And when I'm going to try to find, here's the Q&A. All right. So first question I got is coming from Mark. Can the invoice decline be because DVMs are treating patients differently? Would investors couple average invoice with number of patient visits? It's a good question. If there was new medical technology or something new medically that revolutionized or changed the industry, I think that would be something that would be looked at. The likelihood that 3+ years of invoice decline is because patients are being treated differently, I think is unlikely. Everyone does look at average invoice, and average invoices are going up. That's a lot due to how aggressive people have been with pricing. It's a little bit hard to tease out product mix from, meaning service and product mix from the invoices, like, is the treatment that's being done materially different? But I think most investors would say that if there was a change in a year or maybe even 2 years, that could be the cause. But something that's gone on now for 3+ years, I don't think that's going to likely be the investor view. Others
I would also just add, Rich, that investors in general will be a little leery of more price being available to take, given the narrative kind of throughout the country around how expensive veterinary care has already gotten. And so they would view that as a somewhat risky path to growth. which is
Yep.
why invoice growth and visit growth is a big focus for them these days.
Yep. All right. Let me go back to questions. Ina asks, our hospital is located in Greater Vancouver. Do the economic trends you mentioned apply here up in Canada? So I have two things. One, we are definitely taking clients in Canada. Michael Kemp was hired a year ago and is doing great. And we've got probably almost 10 clients in Canada that we're working with and growing that business. I think the economic trends in Canada are different than the US. There is a bunch of overlap. We are going to try to do some webinars specifically to the Canadian market, but I would say the trends are different. They're better right now in Canada than in the US. And we are taking clients. So, next question. Do you think United Vet Care will go bankrupt? So I highly doubt it. And I don't like to talk about specific companies, but let me give you the concept of, for all of these consolidators, these buyers, I think it's unlikely that any of them really declare bankruptcy. And the reason is these businesses all sold at 15 to 25 times EBITDA to their private equity investors. And those investors only borrowed like five times EBITDA. So the amount of equity capital that was put in these businesses was really high. If a business was bought for 8 times EBITDA and they borrowed 5 and they only put 3 terms of EBITDA in, much more likely that an investor would let it go bankrupt. But when they pay and have 10 times EBITDA as equity capital, it's unlikely that the investors will give that over to a lender. So hopefully that makes sense. It's a financial answer, but it's hopefully relevant. Hope is asking, do you have a list of the names of the veterinary corporations throughout the country? Like fact, some only own 5 practices in LA and others own 20 on the East Coast, so they aren't competing with each other. So we know who all the consolidators are. We don't publish a list. That would be sort of giving people some of our expertise. We have maps internally of where everyone owns their practice. So we have really good market knowledge, and Hope, we're happy to talk to you about it, but we don't publish those kind of lists at the moment. Someone asked on the chat, private market valuations, 1 and 2 doctor practices. And so, Robert, I think the way to think about this is 1 and 2 doctor practices rarely sell to corporations. They usually sell to other veterinarians. And if you're selling to another veterinarian, that's usually at 5 to 6 times EBITDA. When a smaller practice sells to a corporation, some of the following conditions need to be met. The 1 or 2 doctors need to be willing to stay for a long time. The building needs to have the capability to grow. So you need 3 or 4 exam rooms. You need to have a building that can have 3 to 4 doctors at minimum. And you need to be in a really good geography for someone to take that risk. And so we have seen 2 doctor practices in particular sell to corporations that meet some of those conditions. Rarely have we seen 1 doctor practices do it. Another Mark is asking, the stay 3 years term, I never understood how that's supposed to work exactly. How exactly is the phase out schedule, as it can't be full-time for 3 years and then gone? And if we are responsible for maintaining the numbers by hiring and managing the 3 years, then why don't we simply do it all ourselves over 3 years and sell as a turnkey operation? So if you make yourself irrelevant as a practice owner and are able to hire doctors so that you're not producing anything or producing very little, you can sell a business as a turnkey operation and you can usually retire within 6 to 12 months. When I said a 3-year term, I was very specific that you need to be a producing doctor. And so if you are a producing doctor and it's time for you to sell, you can say, hey, I'm going to take the risk. I'm going to try to hire more doctors now over the next 2 or 3 years and get my production down to zero and then sell. And you can do that. The question is, if you don't succeed at hiring those doctors, then you're 3 years later and you're still producing and it's a problem. And so a lot of folks aren't as planful and don't think about making themselves irrelevant from a production standpoint. And so that's why we talk about this at almost every webinar, is for those of you who are 52 years old and want to retire at 60, your goal, if you never want to work for a corporation, is to make yourself irrelevant over the next 8 years. If you're 62 years old and you haven't made yourself irrelevant, I would strongly encourage you to go through a sale process and not take the risk, because you may not be able to get those folks hired. And the older you are, the harder it is to sell at full value.
I think too that if that question's being asked through the lens of, okay, so I sell my practice, I'm expected to be there for 3 years, how does it all work? I think the two things I'd point to there, one, corporate buyers understand this timeline and they want to be able to kind of ramp you down as the seller and hire behind you. And so transparency with each other around when you really want to stop practicing medicine gives them the leeway to then hire your replacement so that you aren't stuck at the end of the contract and, no one knows what to do. And likewise, when you're selling to a corporate group, the expectation that you're doing all the managing and all the hiring goes away. And so that isn't necessarily something that you would expect to do post-sale during that 3-year term. Most sellers, the full expectation is that you are just doctors.
Yep. So James is asking, how much of the decrease in invoice numbers is due to the rapidly escalating fees being charged these days? So I am not a researcher that can tease that out. My impression is that a lot of it is due to that. I think what my personal view of what happened in our industry is in 2021, everyone was crazy busy, understaffed, people were overworked. And when that happens, people raise price, and it's sort of appropriate. But if you raise price too much, it scares away your clients. And I think we have seen the after effects of this, and staff were getting higher wages into 22 and even into 23. So people kept raising price. So I think a big piece of this is the rapidly escalating fees. I can't prove that out with data, but I can tell you that that is my educated opinion. I can't pronounce this gentleman's name, but he's asking, is it better to do JV versus selling the business 100%? And the way I would describe that, and let me make clear. So a JV or a joint venture means that you retain ownership in your own clinic. And that is a really good strategy for certain sellers, and selling 100% is a really good strategy for certain sellers. And the way I describe it is, one, if you're a 2-doctor practice, most likely the way to get a deal done is to do a joint venture, because no one wants to take the risk that one doctor leaves and becomes a 1-doctor practice. So smaller practices are more likely to do JVs. The second is, it depends on your age and your time frame to retirement. If you want to retire soon and you want to become an associate and not work hard, we recommend people sell the whole business. If you're 55 and tired of managing the practice but plan to work 5 to 7 more years, we recommend that you do a JV typically. And so it depends on your personal situation, the hospital situation, and we try to help owners figure out what's best for them. So there's no cookie cutter answer, but I'm hopefully giving you some ways to think about it. An anonymous attendee is asking, I just finished building a brand new standalone facility and have 5 doctors. Do corporations typically want to purchase both the real estate as well as the business? I'm wondering if I can maintain ownership of the building and charge them rent. I would say the vast majority of deals that we do, the veterinarian who owns the building maintains ownership after the practice sale and is a landlord. There are certain situations where we recommend that the doctors sell the building. That's typically when you've got multiple owners of the building and people may retire to different places. And if you have multiple owners to the building and what the age differences are very different, we also sort of recommend that the building gets sold because no one wants, you don't want, you may get along well as partners, but if a partner passes away and then you're dealing with their heirs, it gets complicated. If you're a sole owner of the practice, sole owner of the building, totally a financial and investment decision for you to make. And the buyers never require the corporate buyers never require the sale of the building. Some buyers are willing to do it. And those buyers that are willing to do it, and if the seller wants to sell, we also try to get bids on the building on a standalone basis to make sure you're getting good value. So that's the building. Mike says, my opinion is the invoice drop is due to the continual pricing insensitivity over the last decade with less and less perception of value from the clients. Do you agree? Yes. Seems like pricing intensity needs some disruption before we can gain invoices back via annual services. We learned this in 2008. Maybe we forgot our way as an industry. So I remember I started my company, VPP, back in early 2011. And the second practice I partnered with then was really struggling. And they had gotten advice from a business consultant in the recession of 08, 09, and 10 to raise pricing aggressively. And I think that that was completely the wrong advice. And it was good for me because I was then able to partner with this practice and help them grow the business back by thoughtful pricing. So I do believe the industry's lost its way or it's gotten too aggressive on pricing. I think the consumer or the pet owner is telling us that based on what they're seeing. So that's my view of that. I think, and so I appreciate the thank yous, but I think we're coming to the end of the questions. I'm going to babble and make comments for about 15 or 30 more seconds to give people incrementally more time to ask questions if you want to. But if we don't get any more questions, I'm going to remind everyone that Wynn's doing a follow-up webinar on Thursday, and you will get an email invite to that. And I will do another shameless plug for our insightful.vet conference, which we're really proud of. And we think if you like this content, there's lots more of it. It's 2 days, it's good CEs, etc. James is asking, have you brokered any sales of dental practices? We have not done dental practices. We're willing to help. We have some partners in the dental space that we might work with. We are doing a pharmacy deal for independent pharmacies. And we are looking at some other niche industries, but we haven't done dental yet. I'll be completely honest, Jim. Happy to talk about it though. All right. I am going to officially say thank you for coming and have a great rest of the evening. So enjoy it.